Is the world losing faith in the U.S. economy? Everything Donald Trump does is affected by this question. Does he need to pull back on his trade war with China after all? Can he really fire the head of the Federal Reserve to get what he wants? What about all those Liberation Day tariffs announced to literal fanfare?
April 2nd, 2025 will forever be remembered as the day American industry was reborn.
But now most of that has been backpedaled and put on hold.
People were jumping a little bit out of line. They were getting yippy, you know.
And perhaps the clearest sign something might be wrong with the U.S. economy, a sharp downturn in one of the safest investments there is. In 1 week this month, investors pulled nearly $16 billion out of long-term U.S. bonds in the biggest sell-off since 2022.
A flight from these safe U.S. assets to something like a gold does underscore that there is just this concern about what is happening with our economy, with our markets, and with our policy.
So it has to mean that something went wrong with the economy.
So what's gone wrong? And how do we know? I'll explain. When Trump talks about how investors were getting a little yippy,
They were getting a little bit yippy, a little bit afraid.
what he's referring to is a steep slide in not just one, but two markets at the same time. The stock market.
An exceptionally brutal day on Wall Street. President Trump's tariffs sparking a huge sell-off.
And the bond market.
Honestly, bond yields, they moved around like a stock.
And on the face of it, we all kind of understand why markets got skittish.
When you freak out markets, you pick fights with your friends, you escalate with the other largest economy in the world, and you create uncertainty by announcing one thing on Monday, the opposite on Tuesday, then doubling down on Wednesday and inflating your numbers on Thursday. Nobody is able to make reasonable decisions about what they're going to do next week, let alone next year, let alone next decade.
But here's where everything really gets all topsy-turvy, because stocks and bonds aren't supposed to tank at the same time. They're supposed to go like this, not like this.
So let's say that there's bad economic news. And so for the bad economic news, you think that Apple is going to be less profitable. You might say, well, given that that's bad news over there, I'm going to go stick my money in something that is maybe immune to those bad profit warnings. And so I'm going to go over to a bond.
Yes, stocks, risky. Bonds, safe. Because U.S. government bonds are literally U.S. government debt. Say I buy a 10-year bond for $1,000. That's actually a loan from me to the government, where in 10 years, I get exactly $1,000 back. But like any good loan shark, I get interest too. Say every year, the bond I buy, it's 3.5%, so I pocket $35 annually. At the end of the 10 years, I also get my $1,000 back and walk away with a neat little profit of $350. This kind of loan, specifically with the US government, is just about the safest play in the book.
Typically, that is the closest thing we have to a safe haven.
Because it's like in Game of Thrones, a Lannister always pays his debts. So too does the US government. It has never defaulted on a US bond. So if you've got money to park and stocks are just too crazy right now because everything's crashing, why wouldn't you want an American asset guaranteed by the strength of the entire US economy and denominated in the world's de facto reserve currency?
Historically, markets have acted as if lending money to the US government was the safest place to stash your money. It's safer than putting it under your mattress, because even if your house burns down, you'll still get your bonds.
Except this time, not everybody saw it that way. Lots of people who held US bonds decided they wanted to ditch them.
Investors talk of a fire sale in the bond market.
And here's where we're going to geek out on one really important concept, because you do kind of need to understand why everyone isn't really freaking out so much about bond prices as they are about bond yields. Remember that $1,000 bond we bought earlier? If everyone's selling their $1,000 bonds, more sellers than buyers, the price goes down. In a fire sale, maybe I can only sell it to someone for $875, but those $35 interest payments are fixed for the life of the bond. So the bond yield has now changed, because I'm not really getting paid 3.5% anymore. I'm actually getting paid more like 4%, really. That's $35 annually on an $875 bond. the effective interest rate on the loan has gone up, even if the interest payment has stayed the same. And those rates, those bond yields, starting on April 4th, one of the fastest one-week spikes we've seen in more than 20 years. And even now, still hovering close to 4.5%.
Safe assets should not move like that. And so it doesn't sound like much, but it was huge.
So now there are two questions left to answer. What's the problem with higher bond yields? And why did so many people sell their bonds in the first place? So when the market begins to demand higher yields on bonds, remember, what they're really doing is demanding the US government pay more interest on its debt. So if the government is issuing new bonds, but buyers all agree 4.5% is the new going rate, then all those annual payments the government has to hand out just got higher.
The interest rate on bonds is the interest rate on America's government debt. Now, if you've ever done the calculation of what would happen to your monthly mortgage payment if the mortgage rate went up by 1/4 percentage point, you'll realize it's a lot of money.
Yep, that's true. To give you an idea, in just a 3-month period between last November and January, the US Treasury issued $120 billion worth of 10-year bonds alone. And those interest rates it has to pay?
The 10-year US government bond yield is arguably one of the most important interest rates in the world.
It's a health indicator, like the pulse of the US economy. It influences long-term lending, so business loans, car loans, mortgage rates.
It could really hurt the housing market in the US if you have long-term interest rates going up.
And maybe even more worrying to economists than that is contemplating why all those investors who bailed on the stock market bailed on the bond market too.
Investors are not viewing, at least the longer term, right, 10 years out and more, US government bonds as safe. They're now thinking about them as also risky assets.
What's weird is at a time of stress, people don't want to be holding money under this particular metaphorical mattress. The mattress that we thought was safe, US government, is not the safest one in town. People are instead going to put their money elsewhere in what they now regard as safer mattresses. That really matters.
Because think of it this way, who buys US bonds? Well, just about everyone. If you have a pension or an investment portfolio, you probably own US bonds. Major corporations buy US bonds. Hell, even foreign governments. Right now, Japan owns more than $1 trillion of US debt in bonds. China is a huge player in that market as well, nearly $800 billion in similar US debt. That's money that the US has to pay back, and that investors have to be confident the US will pay back.
The market's volatile because the underlying drivers are highly uncertain, and we really don't yet have clarity about the magnitude of the tariffs, the timing, the sequence, or how this is all going to work out.
And if people are selling US bonds instead of buying them, that's not just making debt more expensive. It's asking a question. Is the US still the unquestioned focal point for the world's economy? And if it's not the US, then who?